Good evening, everyone. So it's time for the weekly free lessons again, but let us wait for another, I think another 5 minutes for the others to get in. Then we will start our lessons right away. So yeah, to make sure to grab your food and grab your drinks, then we shall start our lessons right away. Today's we'll be talking about the iron condor, yeah. So iron condor, just a little brief introductions of iron condor. Iron condor is actually a strategy that is going to be used in the ranging market. So it might not be useful for the current market since this is now a bull rally and all the stock are just going up crazily without a top roof. So it might not be useful for now, but you can just apply for maybe some very steady ETF, or maybe you'll find some low volatility stock, then you can just apply on it. And in the previous class, we talked about the strategy to be used in the bear market. So if the black swan happened and it dropped like a falling knife, then you can just apply the strategy and make use of the drop. And just give you guys a little bit heads up, the structures of our lessons might change a little bit in the future. So we will like lengthen the time durations for a certain lessons. But meanwhile, we will also give a little bit more in detail, deep practicals that combine with a theoretical class together. So in that way, we can just cover the theory and also the practical too. So you will like a very practicable lessons that can just move you from 0 to 1. At least start your first move to just start your trading and investment in either options also can, either CFD or also just purely stock is also a very good start. So we might change our the whole structures of the lessons in the future. So it will be more have a different layers, and like having a class for beginners and having a class for intermediates and having a class for advanced. So it won't be like currently it is all messing up together and it's like a series classes by different teachers and lecturers. But in the future we will just make it into a very layered details classes. And I will just make sure that, yeah, we can keep the standard up, and then we can just, make sure everybody can understand the theory and also able to make their first step. And we will also cover every details in the execution, so it won't be any problem for you guys to just start immediately after the class. That is the ideal case where we can just make everyone to make their first move, because now many people just come to the class and then after they listen to the whole classes and they didn't make any move afterwards because it's not a really in detail classes. But in the future we will just make it that way. So hopefully we can really start to make some real improvement, at least to start the first step. Then we can grow together. And if there's any detail that we didn't cover in the future, make sure to tell us, and then maybe you can just contact us, and then we will just have a private sections, or maybe a private Q&A to just answer all of those. Okay, it seems like the voice is up. Okay, then yeah, wait no more. We'll start on our today's lessons. And again, for whoever that come in new, I am Ujunlo, and I'm a Malaysia's lecturer that going to teach on any financial knowledge, but I will be major in options trading. And then today we were talking about iron condor. And in the previous class, we have talked about what is options and what is the call options, put options, and also anything the teams like a vertical spread and also the intermediate strategy. But in today, we will talk about the iron condor. But don't worry if you didn't have the basic knowledge of the options, because I will make sure to just do it in a very easy way so that anyone can just understand the theory without any problems. So even though you don't know about what is options, don't worry, yeah, I will cover it in detail. And still, in today's class, we won't sell you any upsell calls, and we will not collect any personal information and money from you. So if there's someone approach you with that purposes, do pay attention on it. It might be a scammer. So yeah, so let's start on today's class, mastering the iron condor. And today's we will only cover this one specific strategy. So we will try to just make it very clear, and we will break it down from A to Z. Okay, so this is for today's journey. This is the agenda for today. First of all, we will give a little bit introductions to iron condor. And then we will just talk about the strategy structures, how to make an iron condor, what is the components that form an iron condor. And then we will go to the real life example. If you do join for the last class or maybe a previous class, we have talked about the bull vertical spread in the class, and we will talk about the example of Apple. And if you do make the same move exactly like we talked in the lessons, you already in a profit. So yeah, so some of these cases might be very useful and might be a very good advice to just apply to it. So what is iron condor? Iron condor is actually a strategy, and it's learning to be profitable when the market is dead. Why I'm saying so? Because this is the perfect way to describe an iron condor. Iron condor is just capturing the movement that trapped within a certain range. And let me elaborate why I just saying it in this way. Why do we use iron condor? Because iron condor actually they can help you to make money when the stock moves sideways or doing nothing. So you didn't expect the price to just break above or going down. Even though it's there, it's just like crawling all around at the bottom, you can still make money from it from time to time. So this is the perfect strategy to counter for a sideways market, a dead stock, I would say. And it profit from the time passing. So every boring day, a quiet day will help you to make money, because when everybody is involving in the market that expected the price to move, and even though it doesn't move, it will hurt their portfolio. But if you build your portfolio, this is the strength of iron condor. Iron condor is to profit from a very boring day, a very quiet day without any big movement, and is used to capture the sideways market. And it works best when there's less excitement and drama. Exactly like what we are describing in the beginning, it's a strategy that used to capture a ranging market. And it's the boredom merchant. Why I think it in this way is because most traders get frustrated when the market is not moving much. But iron condor trader is actually preferring this kind of quiet period, I would say. So you are essentially just selling the excitement insurance to the other. So when you're selling the insurance, right, you do collect the premium from them. So that premium itself is your profit. And then when you keep on selling this kind of insurance and there's no excitement happen, you will keep on collecting the premium from them from time to time. So you can just think it in this way. Iron Condor is actually just selling the excitement insurance to the other. So you want to avoid the things happen, which is the excitement in the market. If the market do move very violently, and then you will suffer a losses. So if there's no excitement happen in the market, you will just collect the premium from the other parties from time to time. So it's just like collecting the rent from the market boredom. So when the market is dead and while the others are waiting for a big market move, you actually are collecting the premium while nothing happened. So the more boring the market behave, the more likely you keep all your premium. So, but do pay attention on it. One important note. A dead market that we described here is not necessarily means zero volatility. It means a very predictable range-bound movement so that you want to have enough movement to create the premium in the options. So it do need some movement, but not big, not as big as you will suffer a losses. But that movement will be enough to create the premium for you to collect. So it's similar like owning a tall booth on a highway with steady, predictable traffic. When you are owning a tall booth, you don't need a very exciting rush hour or very traffic jam to make money. You, as a tall booth owner, you're actually preferring a very consistent, boring, regular flow of the traffic. So you can just keep on collecting the money in a very steady way. And I will give a little bit another example for you to have a better illustrations. You try to imagine iron condor like setting up the guardrail on the rivers. So you can see that the picture illustrated like iron condor, which you build two guardrail on each side of the river, and then you will make money as long as the boat stay in between. If there's no crashes happen, if the boat doesn't just go off the river and then crash on the guardway, then you won't make a losses. So you can just adjust how wide you want to make I will call it a safety zone. So the wider it is, the safer it is, but less profit. So you need to adjust according your risk preference, the P&L that you prefer. And time is your friend. The longer the boat stay in between the rails, the more money you will make. And if the boat hit the guardrail, then you will lose. As simple as that. So you can just imagine that Iron Condor have this kind of special trails, which you are not betting up the stock to goes up or goes down. You just want it to stay relatively stable. You just want the boat to stay on the river without crashing on either side. And you can know exactly how much you will make or lose before you start. There's a mathematic way to calculate it, and we will cover it in later example. And you collect the money upfront, which is the premium, because we already describing it like selling an excitement insurance. So for insurance, you collect the premium upfront, and then you pay if any bad things happen. In this case, if a big move happen, you pay at the end. So you as a seller, as an excitement insurance seller, you are actually collecting the premium upfront. You don't need to pay anything. And once you make these kind of strategies into your plan, you collecting money. So there's no cost for it, and then you will just collecting the premium upfront. But it is also a very, I would say, a patience person strategy, because you make the money slowly but steadily when everything goes as planned. You didn't for this kind of strategy are unable to catch a very big move. You are unable to just flip your account in a very fast and steady way, but you will able to help you to build your portfolio bit by bit, slowly, and just accumulate your wealth. So yes, so we will talk about when to use it. First of all, it target for a ranging market. So the first ideal case is it need to be a range bound market. And then it is better if there's a very high implied volatility, because you are primarily as a seller, so you actually need a very high volatility so you can collect a higher premium. The higher the volatility, the higher the premium is. You can just referring back to the lessons 4, we talk about the grids, which we will talk about the relationship. We already talked about the relationship in between the volatility and the premium price. And you are expecting the volatility contractions. So yeah, we will just go into the structure right away, so stay tuned. And this is 4 moves that going to build one iron condor. First, there's 2 selling and there's 2 buying. And I will just go through one by one. First, you short a nearer out the money puts, and then you buy another further out the money puts. And you can see there's 2 puts and 2 call here. It is the same move where you're selling the nearer OTM call or put, and then you buy another further out the money call and put. It might be confusing in this way, but just bear with me, and then we will go into the example real quick. Okay, so this one is the chart that I'm going to use as an illustrations. So you can see actually the current price, after the market movement, the current price fall in $100. And then first you need to identify the range that is considering the profit zone, that is considering your safety zone, which is the I would say the wide of the river in previous case. So first of all, there's time until the expiration, and in today's class, we are going to talk about options with a 1-month expiration date. So first of all, you identify the safety range, and then in today's case, we will just have a range of in between 80 to 120. So what do you do on this kind of specific prices? First of all, you do a selling on this kind of specific cases. Do not worry, we will go into the real life example afterwards. Okay, so first of all, you make a selling on this kind of strike price, and then you will be benefit, you will collect a premium from it because you are selling the excitement insurance. So now you're collecting a premium upfront. So when the market move in between this zone, you won't suffer any losses. You will keep your premium that is received upfront. And if the movement just break through this range, you will start to lose your money. Like this, when the price moving up, it break the 120, it just go out of your safety zone, you will start to lose money. And even though it's going up or going down, also doesn't matter. Once it just move out of the safety zone, you will start to lose money. And what happens if it just keep on going up and up? So you will see when it keep on going up and up, you won't have a limitations on your losses. You will have a no cap losses in this case. Your losses are not limited. So you want to avoid of this kind of thing happen. So we want to make money, but we do need to make sure to know the risks upfront. So what we do, we actually limit this kind of risks by having an opposite positions, which let's say that now we want to limit the risk in between 70s and 130, which is a $10 range will be identified out of our losing range. And then we will do opposite positions on this kind of specific price. So we buy a call and we buy a put below. And what happened now? If the price goes up and then it just quick off the safety zone, it enter in between 100. Once it just break through 120, you will start to lose money. But once it hit the 130, you will arrive at what we call a maximum losses here. because anything above the gray area here is offsetting each other. So the losses that you will suffer is just a $10 wipe in this case, because you limit any potential losses beyond 130. So when you're buying, you're actually paying the premium upfront. And you can see that in this case, the green area here is your safety zone. If the price stay in between, you will make money. But if it break above 120, you will start losing money. And you will achieve a maximum losses when it arrive 130. And anything beyond 130, that will offsetting each other and it doesn't make any impact to your P&L. As simple as that. So when you are selling in the beginning, you're actually collecting the premium upfront and you do opposite positions to limit the risk. So you're actually paying a premium to just limit the risk. And eventually you will also receive a premium upfront. I will just show you when we are doing a live example case. And this is the calculation method to just do the mathematics upfront. The maximum profit here is the net credit they receive, which is the premium they receive upfront. And then the maximum losses here is actually the white in between the strike minus the net credit. In the previous case, the white between the strike will be $10. And you need to minus the premium that you receive upfront. And the break-even price will be the nearest strike price, which is the 80 and the 120, add on the net credits, as simple as that. Now we'll move into the real life example. Now we're done with the theory and we will move into the practical part. We will have a Q&A session at the end of the lesson. So if you are unclear of that, if you have any questions or you're unclear about the theory and the practical part, you can just raise the questions at the end of the sessions. So bear with me. And this is the little tips that I will suggest to be used when you want to construct an iron condor strategy, which is also my personal tips to be used in the technical analysis part. And I don't think you are able to find this kind of tips anywhere else in the market because it is my private personal skill to be used for iron condor strategy. And it's not, I won't say that it's 100% correct, but you can refer to it. First of all, I will look at the delta. Delta is equal to the winning rate of the options. Actually, in the most complete description, it means that the chances that the options to be fall in the money at the expiration date, but you can just referring to a winning rate, as simple as that. When you're referring to a simple human language, this is equal to the winning rate of the options. Now, when you take a look at this one, which is in this case, we are using the S&P 500 as an example. And when we look at the delta here, you can see that there's a delta for call options and the delta for put options. And how do we describe it? When you are buying a call, it means that you are betting the price to go up. And you can see when the strike price is lower, you do have a higher winning rate. And for the bottom one, when the strike price is lower, 611 for the strike price, you will only have the delta of 0.374, which means a winning rate of 37%, 37.4% if you buy on the call option with the strike price of 611. With the current S&P 500 price allocated on 604. So you can see when you are betting the price to go up and you are buying a very lower strike price options, you do have a higher winning rate. And it's vice versa for the case of puts, because puts is actually you are betting the price to go below. So in this case, when you are betting the price to fall, then you have a higher winning rates if you are targeting on a higher strike price. So as simple as that. And I will just show you on the chart on how to just illustrate it. And for the beginning, we will just, the first step is we want to ensure the safety zone. So let's identify the safety zone with in between 600 and 610, 600 and 610. And with the current strike price, the current market price on 604, we do make a sell put on bottom and make a sell call on the top. And this is how you look at it in the chart. And this is the chart for S&P 500 when the market price, capturing at the time, the market price is on 604. So you can see the market price on 604, and then this is the safety zone that I want to build a iron condor strategy. And how do we just referring back to the delta? And you can see that the chance that it break above 610 is 39.6%, as simple as that, because the delta is 0.396. So it equivalents that the chances that it break above is equaling to 39.6%. So for the other part, you can see the delta is negative 0.397. And the negative here is actually referring to a put options, but not a call option. Call options, you have a positive delta, and then put options, you will have a negative delta. As simple as that. And so that what is the chance that it break below 600? The chance that it break below 600 is very simple. Just referring back to the delta here, which is 39.7%. As simple as that. So this is how you use the delta to identify your winning rates. So the chances that it break above is around 40, and the chances that it break below is also around 40. As simple as that. Okay. So this is the first indicator that I'll be using for iron condor, the delta. And then we will move into the average to range, the ATR. What does the ATR mean? ATR is actually measuring the average daily movement of that particular stock. So this is the chart. If you put on a ATR indicator, and you can see from the bottom there, the ATR is actually now falling on $4.49, which means by calculating the previous 14 days, you can know that the average movement of the day is around $4.49. So when today's market open, what will be the chance that it will goes up or goes down? If it goes up, then you will just add on $4.49. If it's just falling down, you will just deduct the $4.49. So this is the possible price that it will be falling on when today's market is closed. So you can see it can either goes up to 609.17, or it can just drop to 900.19. This is how you describe an ATR. So, but why you need to know about the ATR? So you can know about if you already set up the safety zone, how many days that it takes for a maximum movement so that it can just, quick move out of your safety zone. So if you set a safety zone with $5, you are expecting the price to break above or break below within 2 days, because for 1 day movement is about $4.50. And then if you are setting a safety range of $5 only, then you are actually expecting it to break within 2 days. As simple as that. So this average true range is actually helping you to identify the either to measure the time, and also the space. And then the third one is the Bollinger Band, and it's actually to help you to identify a standard deviation range. This is how a Bollinger Band looks like, and then you can actually just ignore the pricing for on it, because we only want to know about the standard deviations. what does a standard deviation mean? The standard deviation is simple. This is the range of standard deviation. And if you want me to describe it in a simple human language way, which means this is the normal, under normal circumstances, how many pips of, how many dollar of movement that you make, just like when your mothers and your fathers are yellows and white, you are unlikely to born black, right? So this is what we call a norm. So if your mother and father are very skinny persons, you are unlikely to be a fat person too. So that is what we call a norm. And you can just understand the standard deviation in this way. So under a normal circumstances, it will move with this kind of movement. And the one standard deviations for the S&P 500 in today's case will be $12.77. So my personal preference when I identify the safety range will be, I will give a buffer of 1 day movement on it. So under normal circumstances, it will move for $12.77. So I add on the buffer with 1 day movement. So I add on the average true range. So in this case, I am able to build this safety zone. So with the upper bound of 622 and the lower bound of 587. Very simple. I just use the standard deviation, add on the average true range. So that under normal circumstances, it will move in between $12.77. But I give on an extra 1 day buffer movement because I add on the average true range, and you will make this kind of safety zone. So in that case, this is unlikely to break above or break below. So it will have a very high probability that it will stay in between these one. And we can referring back to the delta 2 to just refer to what will be the success rate of this safety zone. And when you check back on the delta for the strike price of 622, you will get a 0.207. So the chances that it break above 622 will be 20.7%. So the chances that it stay below 622 will be around 80%. And what is the chances that it break below 587? It will be around 23%. So the chances that it stay above 23% will be around 76%. So you can get the probability that it's staying in this box is around 55.7%. Simple mathematics, because you consider all of the possibility. You use 100%, deduct the possibility that it break up. So you use 100%, deduct a 20.7%, then you use the remaining portions to just deduct the 23.6%. Then you will get the probability that it stay in between this one. Because the probability that it break above is 20.7%. And the possibility that it break below is 23.6%. So you get the possibility that it is staying in the box. So with me building this kind of safety zone, my winning rate for this strategy will now become 55.7%. This is how you understand it from using delta. And right now, if I'm going to do a short put and a short call in this kind of safety zone, this is the premium that I will collect, which is $608. And with the sell call, I will get a $238. And with the sell put, I will get a $370. You can check on the price here, and one option is equal to 100 share. So you will need to multiply by 100 afterwards. You use the 2.38 plus the 3.7, then you multiply by 100 and you will get 608. So you have a winning rate here, 55.7%, and you have the premium, the maximum profit you will get, which is 608. But you need to bear in mind this because you only do a selling positions. So If it break above or if it break below, you are actually have a possibility of unlimited losses. So we want to avoid that kind of thing happen. We will limit the risk by opposite position. So in this case, I will have a buyer positions with a $2 wide. So you can see that with a $2 wide, I will just buy a call with a strike price of 624, and I will buy a put with a strike price of 585. As simple as that. So you can just have a summations on the premium received and also have the premium that you pay. For the buyer positions, you need to pay for 199, and you need to pay 350 for the buyer position just to limit the risk. And the seller position, you will receive the premium because you are actually selling the excitement insurance. So in this case, you will get a profit of $59 upfront when you are doing the iron condor strategy. Looks more right, since since the when you're comparing to just a seller positions, it seems like a very small amount, because when you're only doing the seller positions, you are actually having a profit of 600 something. But now the profit dropped to 59 only, but you limit the risk. And if you stay in between the zone, you can just keep the premium and then without paying anything. But if you break above, that means something is wrong, because we do referring this to like selling an excitement insurance, right? So this kind of excitement is happening, you need to pay to the other parties, and the maximum profit in this case will be 200, because this is the wide of the range, and anything above will be cancelled off each other. So you can see that the wide is $2, and then one options is equal to 100 share. That will make it the total losses of negative 200. And if it goes above 624, anything above beyond that, it doesn't matter. You will only have a maximum losses of 200. But what if it doesn't go up and it goes down? Same case, because the white for the bottom there is also a $2 range. So the $2 range multiplied by 100 share, it will make your maximum losses become negative 200. So if anything drop below 585, it doesn't matter, because it's canceling off each other with the selling positions and the buyer positions. So now you know the case. You know the probability that it stay between you know the maximum profit that you get, and you know the maximum losses that you get. This is how you check on an iron condor. As simple as that. You have the probability of your winning. You have a 55.6%, say 55.7% of winning rates, and you do have the maximum losses and maximum profit. But this is the interesting part. If you doesn't make an iron condor, and you only do one side, you didn't do the upper side or the bottom side, you only do one side, your possibility of winning will be actually greater, way greater. You can just check on this. If you are only doing the upper part, which is the 622, and then that will make it a credit bear spread, which we already teach you guys in the previous classes. And in that case, your winning rate will be around 80%, but not a 55.7%. And about the credit vertical spread, you can just check for the previous class for the bear conditions, and you can check for the bull cases in the previous recording also. If you are interested, you can just contact me at the end of the lessons. Then maybe I can just teach you again in the private manners. So now this is how we already talked about how to build an iron condor, and we have talked about how do you identify the safety range? What my personal skill to identify the safety range, and also the indicator that we be using. The first of all is a delta to check on the winning rates, and then we will use the average true range to know about the daily movement it can move. And then we will use the Bollinger Band. We don't use the indicator. We just want to know about the standard deviations, which is under normal circumstances, how many dollar movement that you will move. So we know about the movement. We add on the buffer with the ATR, and then we referring back to the winning rate. If the winning rate is way above than 50, we do want to make sure that we are on the more favorable side. So we need to have a winning rate higher than 50. Then we can make a strategy with a higher winning rate. And if you just add on way more buffer, your winning rate is actually increasing according to the strategy that you plan. But the risk to reward ratio might not be as delicious as it should be. So you need to adjust accordingly the wide of the safety range, and also the risk and reward that you will be paying and you will be receiving. So this is about today's strategy on Iron Condor. So Iron Condor is actually making money when the stock moving sideways or doing nothing. This is a strategy to counter for a ranging market. As simple as that. And then to thank you for coming for today's class. If you have any question, you can start asking now. And this is actually my personal WeCom that you can contact me, and then you can just ask any financial related questions or any investment or trading questions. And if you have any desired topic that you want to discuss, we can also arrange a class for that. And at the end of the lessons, I will just share a little bit of benefit for opening a UseSmart account right now. If you open a UseSmart account right now, you're able to get a 0.02 share of Tesla. And the more you deposit, you're able to get more cash voucher. And on the right side, you're able to check on the QR for registration. The above QR is for the SG, which is the Singapore apps, and it is for a global user. And the bottom QR is for a Hong Kong user. So this is for registrations. And if you have any questions, you can start asking now. And if we don't have any questions, that we will just end for today's lessons. And I just give a little bit introductions of the following classes. For tomorrow, I will have a Chinese class that talk on the vertical spread, the bull vertical spread. And this is also the strategy that you can just check on but if you are a pro user. If you are a pro user, you can receive the strategy that we recommend every day. And most of it will be a vertical spread. So if you come to tomorrow class, you will know about what is a vertical spread, and you can apply it according to our recommendations, according to our strategy, and then you can just apply it into UseSmart interface and start your trading journey. Many people are unaware of how to set things up, how to set all those vertical spread up. So by listening to tomorrow's lessons, you're able to get to know of how to set up a vertical spread. And I do have a Friday class that will speak in English, and the Friday class will be a recap class that is going to talk about call options and put options. It's just like a very essential class that make everything in a nutshell. So I will talk about the call options and the put options, and also I will talk about what to pay attention to when you're picking up an options. And if you are a total beginner, feel free to join for Friday class. And if you want to start making profit with our recommendation, with our strategy, and you can join for tomorrow class. But do pay attention that tomorrow class will be in Chinese and Friday class will be in English. And once again, if you don't have any questions, we shall end for today's lessons. Thank you all for joining. We will end our classes here. And thanks for joining. Thank you.